Hi, this is Eric Boyce, CEO and Chief Investment Officer of BKA Wealth Consulting, and welcome to Charts and Chat, June 6, 2022. Please share a disclaimer for important information. Well, as we get started this week, I want to highlight a little bit of change in our programming here. So those of you who also listen to our market minutes will notice that I'm really trying to streamline that program a little bit more to kind of give you the news that you can use on what happened last week and really what to expect in the week ahead. And this is going to focus on continue to focus on, some of those very interesting charts that I come by in my daily reading, but also kind of delve into towards the end of this broadcast, kind of like, some of the things that are kind of driving the market, some of the things that are really kind of on the market's conscience, kind of driving market behavior and sentiment, so on and so forth. So we'll kind of get through some of these charts and perhaps maybe a little bit faster tone, and then kind of get to perhaps some of the news for the week. But again, I'd say that this is my ever-continuing journey on trying to deliver content that is useful for our friends and clients, but also deliver, really what our clients foremost and our friends of the firm really enjoy. So as we get started this week, I mean, obviously, inflation is a headline. What's interestingly enough is that we've had COVID kind of back into the picture a little bit. We've got cases rising, but really, I mean, there's so much COVID fatigue out there that it's not gaining mind share in the investment world because of what's going on with inflation. And we'll get a CPI report later on this week, expecting really 0.7% on the monthly number for May, and then we're expecting 0.5% at the core. So, that's weighing on sentiment. Clearly on the economic surprise index, we've had kind of puts and takes here. I mean, on balance, it's actually negative, although honestly, last week we had some, reasonable data. And I guess the data is frankly not entirely bad. In fact, economy added 390,000 jobs in May, which is more than expected. Unemployment rate still at 3.6. Participation rate was actually up a little bit, so we got more people re-entering the job market. And so obviously, labor period is pretty tight, but average hourly earnings were up at a level that normally we would, think is terrific. But in the face of this outsized inflation, real wages are actually negative. Real wage growth, I should say. So, but business sentiment remains rough, pretty much solid, even though the surprise index here on the left-hand side is still negative. And obviously on the right-hand side, we've got the surprise index for housing and real estate. And so I think there's a clear understanding now, especially with 30-year fixed mortgage rates pushing towards 5.5%, that we're seeing fewer applications. We're seeing buyers just simply pulling back, and we're seeing a little bit of kind of a truncation of some of this price growth that we've seen. Now, still year over year, it looks the numbers are incredibly phenomenal, but on a sequential basis, it's beginning to slow down just a little bit. But I'll also follow in with, as we're looking at this economic surprise index, clearly the Institute for Supply Management, the ISM manufacturing number, was ahead of expectations last month, and the Institute for Supply Management Services survey was still pretty solid. And both are kind of in that 55 to 57 range, and anything above 50 is expansion. Earlier on, we have seen fairly strong numbers, like above 60, which is just incredibly outsized growth. But really, unless you see something kind of like touch the 50 line or the midline, so to speak, I wouldn't worry too much. But business activity, again, pretty strong, despite the fact that the surprise index here is fairly weak. And as I mentioned in the last slide, we talked about average hourly earnings, and we know that they were up 0.3%, and this is kind of like up 5.2% on an annualized basis you can see the trajectory of this over the last several years. So, for a while we had wages that were really outpacing inflation by a fair degree. And so you could see that, the households were getting in better shape, balance sheets for the households, debt levels going down, savings rates moving higher. And then obviously you had the spike with the pandemic and all the transfer payments that we got from the government. But that number continues to move higher. But this is what I mentioned in the last slide. It's an odd juncture to have this moving higher at the same time. We've got ultra high inflation, so these real hourly earnings are actually still negative to some degree. Here's U.S. personal savings as a percent of disposable personal income. And so, here we are at the juncture of higher inflation and wages kind of stalling. And so this is kind of what happens in the wake of that. You get personal savings rates going down. People are spending out of savings. You see credit card balances moving a little bit higher. Again, it's not a panic level at the moment. You do see these levels kind of back down to levels that we haven't seen in really 14 years almost. So, that in and of itself is worth noting. Savings rates have come down quite a bit, but this is something that we're going to have to watch going forward. That to see whether this this savings rate moving down is going to ultimately affect consumption. And here's a quick check-in here on the conference board for consumer confidence as consumers judge business conditions 6 months forward. And so this index, which measures the perceived confidence in better business conditions 6 months forward, has dropped down to levels that we haven't seen in a few years. Of course, from a consumer's perspective, it's what they do, not necessarily what they say. Obviously, there's a lot at play here. Inflation is just one aspect of it. I'd say, if you look at it from a secular basis, I mean, we're still at levels that clearly we didn't see back in the 2010s or even prior to that. We're back kind of, we've retouched this level from 2018, 2019, which is about where we were, back in the early, post financial crisis era, and even, perhaps even 2003, 2004. Clearly confidence on the part of the consumer is being impacted. Here's CEO confidence. Again, this is more kind of confirming data to just show that sentiment is particularly weak. Here's a slide that shows us the net percent of banks that are tightening their lending standards. And we do know in that gray line that folks are tightening credit right now. I think banks are kind of playing a little bit of defense with rates moving higher. They want to make sure that credits are credit worthy. And this is inherently cyclical too. And you can see this overlay of high yield bond spreads, which again kind of marries the economic data point with more of the market data point. You can see there's a pretty tight relationship here. And so, the expectation is that we're going to have bond spreads move a little bit higher, which from a portfolio management standpoint gives us a little pause on high yield. And so, we're looking at that part of it pretty closely. Now, we have seen just a modest uptick in credit erosion. Or I say a modest downtick in credit quality would be the better way to say that. But it's not been something that that we really would worry about at this point. But obviously, the trend, given this correlation, is that it's likely to go higher, and so we will clearly want to manage our portfolios accordingly. Here is the Institute for Supply Management Manufacturing Purchasing Managers Index. And you can see here that the survey 54, actual was 56. This is what I was describing earlier. You've got new orders. Again, another diffusion index. So anything above 50 is positive growth for new orders. Really important here, even though it has come down over the course of the end of 2021 and into 2022. So this is not like something that is just developed. This is a trend that's been building a little bit, even as the market has been going higher. But again, when you look at the shutdown, you look at the associated recovery that followed, again, you can see, as I mentioned earlier, that you had numbers for many months that were above 60, and that is outsized, that is highly unusual growth. And so we're coming down to a level, hopefully, if we can settle, and hopefully if the Fed can somehow navigate a softer landing, or at worst maybe a mild recession, then these numbers should hold a little bit closer to the long-term historical trend lines. Well, here's ISM inventory. So inventories have picked up quite a bit, and there's multiple ways to read this. Obviously, inventory growth is a definite contributor to GDP, to economic growth. And we know that with supply chain issues, that cupboards were bare, shelves were bare for a lot of product. A lot of that product has now been replenished. One takeaway is that you're going to have rising inventories if you have demand destruction because of inflation. That's true. And also you could have, inventories rising because manufacturers and distributors want to stock up on product for fear that prices are going to continue to move higher. And so, you see inventories remain high, but I think it's a much better environment to have inventories that it'd be much better to see inventory replenishment rather than lean inventories where there's demand for product that's not there, and then you get a secondary price shock. Supplier deliveries on the right-hand side, that number has come down, but it's kind of been sticky. So we continue to watch that as well. Here's the PCE price index, the Personal Consumption Expenditures Price Index on a year-over-year basis. And so obviously a number which is very, very important to the Federal Reserve and the Federal Open Market Committee. We see, that number roughly 6.3. We did see the first downtick, even though the aggregate levels, as I sit here, are the really at the highest levels that we've seen since 1982. But with this outsized inflation, it's clear that the market is going to want to see a downtick. So when we get the CPI number later this week, we'll see the PCE numbers, soon enough. And, we want to see that roll over, even if it's not by a very precipitous amount, but something that's just incremental. It continues to feed this theory that, okay, that the Fed's job may be done sooner rather than later, and that they're not necessarily going to have to be as aggressive towards the end of the year as some might speculate now. Here's ISM new orders minus inventory. So we were just talking about both of those here lately. So essentially we are at a level of new orders relative to inventories that is back down to levels that we haven't really seen. Well, if you back out and go beyond the start of the pandemic, we haven't seen those levels since like 2016, really. And so, basically what this is kind of telling you, you see the ISM PMI, and there's clearly a positive relationship here. And we know the PMI has rolled over, but it's still above 50. But when you take that new order and you subtract inventories, which we know has gone up, that's what's bringing us down to this level. And so right now we're keenly concerned about how new orders stabilize going forward, because that will then soak up some of that available inventory. Here's a job openings survey. Again, the actual number was just slightly ahead of expectations. You see the trajectory. Interestingly enough, job openings have tailed off a little bit. As I mentioned in my open comments, we've had increased labor participation rates. So we've got more people getting back into the workforce, and there's still an over supply of open jobs to the amount of unemployed in the market. So people are still hunting for workers, obviously very tight labor environment. Here's the China data, market manufacturing PMI, and it's advanced 3 months on the blue line, and then the black line represents the Chinese manufacturing index. And again, I love these charts that have really tight relationships, like tight correlations, and this one is no different. So when you have the PMI that's advanced 3 months to kind of foreshadow, you can see the ISM manufacturing index is likely to fall. Now, if that's the case, obviously that has repercussions across the emerging market world, which is one reason why we are down ticking our exposure into emerging markets. And obviously China, these numbers are a byproduct in many ways of the massive shutdown that we've seen in China at a time where we know the Chinese vaccine doesn't work, and because of the previous lockdowns, it's hard to really see a lot of like herd immunity, if you will, because people have been holed up for such a long time. They haven't really been able to get out, and very few people have the virus, and when they get it, the vaccine doesn't really work, or I should say the vaccine doesn't prevent them from getting sick. So, now you have this China economic growth situation. As much as people want to talk about Russia and Ukraine, I think this is an important story as well. Here's the percent of investment grade bonds trading below par. And I thought this was particularly interesting, not only in terms of its magnitude, the data series that goes back roughly 10 years, but it just shows you the degree to which, now with the inverse relationship between prices and yields. So it just shows you the degree to which interest rates have moved up. And because obviously credit quality hasn't really eroded. We talk about that, at least not yet. Most of the spike here in the number of bonds, and again, we're talking about 80% of the outstanding investment grade bonds that are trading below par. It just shows you that prices are down and yields are higher, and that yields are ruling the day right now. And here's a chart from ICI equity fund flows globally. So this is getting outside the U.S. a little bit, and that we had a really stout negative outflow, and then pretty benign readings, at various points here post-pandemic. But we did see a slight uptick following a pretty strong 2021. So we were beginning to show some weakness in fund flows globally as money was being pulled out of the equity market with the high inflation, but we're seeing at least a slight tick up in that. Here's a chart of the S&P 500. It's from JP Morgan, a really illustrative slide here going back to 96. It shows you these various inflection points where we get these bear markets and recessions. And again, as much as anything, I want to show this to folks just to emphasize a few things. One, market does go down, and there are times where it goes down rather dramatically, but it comes back up. And you can see the period of time at which it takes to kind of recover some of those losses, and but the market generally does do that. Now, we've been up 85% from the low in 2020, even though we're off the peak. You can see that, and so essentially, if you back out the impact of the pandemic, we were due for a sell-off anyway in advance of the pandemic, and you can see the magnitude of the recovery, and this is extremely artificial, but where we are now from a technical standpoint is essentially that straight line from that market bottom back in 08, and it continues. When you plot these things over long periods of time, it tends to mute out a lot of the intra-period volatility, and you can see here that by and large, if you look out long term, that you've got you have to feel better about your growth prospects. And here's a look at our S&P 500 valuation. So we've been talking about multiples coming in, and this is a real good chart for that. We were completely out of line in terms of valuation looking out, literally about 6 to 8 months ago. And so that's come in quite a bit. So the 25-year average price to earnings ratio is just under 17, and we're right maybe slightly above 17 right now. And so we're pretty much at the average. And so it is a pretty telling event when you get more than that one standard deviation away. And I won't go into how that's defined or what that necessarily represents, but as you can imagine, once you get one standard deviation away, the propensity is that you're going to revert back to the mean. And that's exactly what's happening right now. So, aside from the fact that we are all dealing with inflation, and that typically with inflation you get stocks that are re-rated, i.e. multiples change, that we're already seeing that. So now it's possible that we could continue to slide below that mean. It's entirely possible to do that, but I think if you have inflation that's beginning to come down, there are no negative surprises on the horizon with regard to Fed policy, monetary policy, and nothing else develops perhaps even on the fiscal front or geopolitically. And I realize in some cases you're asking for a lot with all that, but basically if you can avoid the issues which are unexpected that the market doesn't like. The market doesn't like uncertainty. But if you can avoid that, then I think you can make an argument over the long haul, despite interim volatility, though over the long haul, stocks have a decent entry point here. And that doesn't necessarily mean all stocks, but certainly stocks that have capital strength, pay dividends, so on and so forth. You could get into a style argument between growth and value, probably more growth stock opportunities here. But nevertheless, stocks are not expensive at this juncture. Well, I actually just love this chart. And I think a lot of folks will find this a little bit kind of wonky, but this really speaks to the power of long-term investing, of looking past the current turbulence and the tempest that you see out in front of the boat and look towards a longer period. So if you look at 1 year and you look at forward PE and subsequent 1 year returns, where we stand now is about 17 times, right? And you can see that there's no relationship whatsoever. This R squared or correlation is like 3% to all these data points. If you look at 1 year, the market could be anywhere in 1 year, and PE ratios here, are all over the map, but they tend to coalesce the longer the term is of your observation. And so, not that this is a perfect correlation. When you go out 5 years and you say, all right, here's a band, equity returns, in this 5 year band are a little bit more predictable. So, if you look out on the horizon, then you could say, all right, here's, it's not going to be outsized. We're about 17 times, and the S&P 500 total return index is just under 10. So again, more predictability here, and there is a relationship between forward PE ratios and expected equity returns. And by this, you can see, obviously, when we were on that last slide, when we were well above 20, that the forward return was pretty bleak. It was either flat or very slightly either positive or negative. In this case, we have a lot more comfort with that multiple coming in that future returns are going to be positive, perhaps up to and including the historical return average of roughly about 10%. Here's number of companies in the white that are trading with single-digit forward PE. So this goes to my point earlier that multiples have come in, and you can see in that white that little tail up. So we've got basically, an increasing number of companies in the S&P 500 that are trading at less than 10 times earnings. Again, these are in many cases value companies. They're not necessarily Amazon or Google or what have you, but still, this is important because you're having value come back into the market, value opportunities. Now, you look at the index in blue, and obviously we've come down, and so there is a relationship here with the market coming down and valuations improving. There's no question about that. So the degree to which the S&P may stabilize here or start to trade in a range around this level until we get more clarity on inflation, you still have more of the market that is investable at acceptable price to earnings ratios. Here's a chart that shows you in roughly time spent in bear markets and recoveries. And so what's clear in this chart, and you get a lot of data here, doesn't really identify for you, where those recession points were, but when you have non-recession bear markets, and again, the jury's still out on this, so we don't know, you tend to have a better equity performance than you do in recessionary bear markets, that are, i.e. Bear markets that are associated with and either precede or follow recessions, or in the midst of recessions, that you tend to get stronger response when you don't have a recession in a bear market. So again, the hope here is that Fed can land the plane on at least 3 of the 4, or I guess 2 of the 3 wheels, but that they get the plane down with not too much damage. So here is a chart from Fidelity that shows, kind of what happens, historical data that shows what happens after you reach earnings growth, the peak of earnings growth, I should say. And some argue that we've seen it. I don't necessarily doubt that. I think earnings with margins being pressured are going to be challenged for some time. This is kind of a spaghetti chart that shows you that you can clearly have negative performance following this. I mean, there are a handful of observations which you can see here in the lower right quadrant of this that illustrate that. But you see the preponderance of occurrences at various points in time, where the market, when you get out into 3 years, that the market is significantly higher. So, we've been using some of these structured notes that have 3-year tails on it. And it has a lot to do with the power of this chart, showing you, even though you may have passed the peak of earnings growth, that you are going to have S&P 500 that's going to be above where it is now, and by a reasonable degree too. Here's a chart on the evolution of recession and expansion links. And I thought this was particularly interesting because of the changes over time. So obviously this goes back to 1800. So you tended to have contractions and expansions that were roughly equal in length. And so you were just as apt to be in one or the other. Of course, you get into the 1900s up through really the end of the decade surrounding World War II, and that begins to change. So you tend to spend more time in expansions. Well, clearly that expansionary phase has extended, the longer you go. And so, in the 2000s, obviously we just, prior to the pandemic, we concluded the longest expansion that we've had on record. And so that obviously influences this. So another chart to maybe put some long-term investors' fears to ease, that clearly this indicates that you spend a lot more time in expansions than you do in contractions. And so if we are in a contraction, and we're not there yet, the data still shows expansion. We witnessed the ISM numbers that I just showed you, they're still above 50. We're not in contraction, but when we do go into contraction, we just generally don't stay very long. So those are all the charts this week. We've got some other data, news about the market. So volatility is measured by VIX, well below levels from past bear markets. This is when you look at market stability and when you think about, oh, woe is me, and this market's going to hell in a handbasket, well, this is as bad as it's been before. Well, I would stop for a second and say, listen, volatility is well below levels from past bear markets. The put-call ratio was about 1.3, which is really far below the 1.7 that we hit back in 2018 and 1.8 in 2020. That is a panic mode right there when you have more people wanting downside protection or people that want downside protection to that degree. Stocks, we still have 30% of stocks trading above their 200-day moving average. It's a little positive takeaway. Bond spreads, and I've talked about this, they have widened a little bit, but they're nowhere close to panic levels. And the American Association of Individual Investors survey, that one, it indicates it's almost a contrarian signal, because we've got 30% more investors that are bearish over the next 6 months than they are bullish, and that's usually a positive sign. And then, when you look at bad news that kind of offsets that silver lining, you think about this: consumer spending isn't falling as much as people had thought. Sentiment, again, is pretty poor. We've seen that worse on many levels than 2020. And real yields have become less negative out there because yields have moved up at the same point that inflation may be coming down. Generally pretty good for investment climate here. And and then we talked about the stronger than expected jobs report. So that'll keep the Fed on track to raise rates, because their dual mandate is price stability and stable employment. So we've got that. And then the Fed is beginning to curb its balance sheet. They're going to allow up to $30 billion in treasuries and about $17.5 billion in mortgage-backed securities to mature every month. And so that's going to be that quantitative tightening. So one thing I want to leave with folks, particularly, everyone focuses on interest rate increases, but I think the real muscle on this tightening is actually going to be coming from the balance sheet reduction as the Fed goes out there and outright not only lets these things, their current inventory of securities, these assets, mature and roll off, but they're actually going to be selling securities into the open market, which puts more supply on the market, which would depress prices and raise rates, essentially raise yields. So I think it's important to take stock of this kind of this backdoor tightening, if you will, that people aren't really paying attention to. The degree to which the Fed is actually tightening money supply is going to give them pause on, I think, or give them the ability to go slower on outright rate increases. And since the market tends to spend a lot of time on that, that would be a positive surprise that I think would be absolutely well received. Housing Case-Shiller, we talked about housing. Home price index is up almost 21% year over year in March, highest since the index began in 1987. But check this out, lumber futures prices are down over 50% from their March high. And so what's happening is these rates are moving higher. Mortgage rates are, 30-year fixed conforming, are about 5.5%. And so, you're showing actual declines in some of these data points. You have sales of newly built homes down 16.6 month over month in April, which is the lowest level since April of 2020. And you've got fewer dealers that say that they have lower inventory now. So that's going to curb price growth, and higher rates tend to lead for less demand for lumber. And so lumber prices being down quite a bit is actually not terribly surprising with that as a backdrop. But clearly the people that are not getting mortgages in this environment are not only the first-time home buyers because they're priced out of the market, but then subprime borrowers aren't getting credit either. Only about 2% of the mortgages issued in the first quarter went to borrowers with credit scores below 620. In 2005, which we know was on the eve of the financial crisis, that number was closer to 13%. So let's see. Other news and notes. So supply chain issues are getting better, but they're still not bad. So in Sandy Lee's notes, he comments it normally takes an average of 45 days for products to be shipped from an exporter in China to an importer in the U.S. Now it's more than 100 days, so that's more than doubled. We've got 12% of ships that are stuck outside congested ports for longer periods of time than normal. And inland distribution is still hampered by a lack of trains, truck drivers, and warehouse space. And that was from an article in the Wall Street Journal. And then, you've got Chinese struggling to, cover their tracks in COVID. Growing concern that China economic data will not be legitimate. And then you've got geopolitical issues. You've got, closer, U.S. driving closer ties with Taiwan. You've got, a lot of armament going to Ukraine. You've got Europe in somewhat of a political disarray, but you've got, a certain amount of belligerence between Russia and Germany, which is prompting Germany now to get on board with this whole oil embargo. Let's see what else. Car insurance premiums are up much as 20%. So you think about this, insurers are paying for longer rental periods, and the cost of repair and replacing vehicles is obviously increased. So that's another thing that's driving inflation. Let's see. And the last thing I'll mention is just an inflation data point. We spend all this time talking about U.S. inflation, and let's not forget that inflation is everywhere right now. And we've got inflation in the Eurozone accelerating at 8.1%, so very consistent with the U.S., and that's up from 7.4% in March and April. So the 8.1 is in May. Energy prices there are almost 40% higher year over year. So clearly energy, food are going to remain in the forefront. We are down fairly low on global stocks of wheat. So when you think about, what wheat does for us, bread, cereals, there's a lot of food and food groups that have starch that, come from wheat. And you think about, even down to your spaghetti noodles. I mean, that's all essentially wheat. And so feel like, we're going to have a real crunch on food. There's global food insecurities are rising. So clearly that's going to be an issue that we're going to have to monitor, because that could bleed into some geopolitical risk too, because the last time Russia had a major drought and decided to keep all of its, or majority of its wheat for internal consumption, most of the shipments to the Middle East dried up, and that's what prompted the riots in the streets and basically what led to the Arab Spring. So I think it's fair to say that, with export curtailments because of the war, that's going to continue to drive that narrative a little bit and obviously keep prices high elsewhere. So with that, we'll conclude today. Again, thanks for rolling with these changes. What I might do is, perhaps do a little bit more of this commentary at the front end of the deck, so you can get that up front and also enjoy the slides. I might perhaps limit the number of slides a little bit more, but clearly there's a lot of information that I love reading. Anyway, so thank you for indulging me. Welcome your questions. Hope you have a wonderful week, and we'll talk to you again soon. Bye-bye.